Good evening. My name is John Stanton. Thank you for joining us. I am the founder and principal advisor at the Stanton Group WP, a financial planning and investment management firm in Naperville, Illinois. Tonight, we're going to cover the 5 unexpected risks in retirement and how to protect against them. So, briefly, our agenda tonight, I'd like to go over lifestyle expense planning, maximizing income in retirement, investment risk, the four most common to manage in retirement, healthcare expenses, how they can derail a well thought out retirement plan, and on taxes, we want to keep more of what we earn. And finally, we'll put it all together with a client case study and review any questions that any of the audience may have. So to start out, we always like to start out the retirement planning process with determining lifestyle expenses for our clients, and we basically want our clients to live the way they want to live. So that starts with defining what your lifestyle needs in terms of spending. We use a worksheet to have an idea. We break down between the must-have and discretionary expenses on a monthly basis. And the key, even during retirement, is to work in a regular amount to save every month and keep building that emergency savings fund throughout retirement. On maximizing income retirement, income sources and determining where your income is coming from is very important. We like to start with our clients on the guaranteed sources of income, determine what they're entitled to, through Social Security, pensions, if they have savings, CDs, interest on CDs, investment grade company, corporate bonds, government bond interest, all very secure. And then there's another source of income called pension annuities, mainly for people that do not have access to pensions. To start with Social Security, I just wanted to briefly review what it's all about. Benefits can start anytime between ages 62 and age 70. Every year you delay taking after age 62 increases the benefit amount by about 8%. And the difference between taking Social Security at age 62 versus 70 can be over 80% higher in monthly income. And this is important because I think I just read that over 70% of Social Security claims over the last few years are taken by people at age 62. So with proper planning, if you can delay taking it until age 70, your benefit can be much higher over your lifetime, and therefore the total amount of benefits received can be much higher as well. And finally, up to 85% of the benefit can be considered taxable income. At one time, Social Security wasn't taxable, but currently it is taxable, at least at the federal level. Pensions can be guaranteed monthly income when you're retired. They can be from a private company provided. They can be from a public job that a client had, or a private union provided. Currently, only 16% of private companies offer pensions. So in the private sector, it's becoming less and less of a benefit, although there are still some Fortune 500 companies that are offering them. The options to take pensions include taking it on a single life. It can include a survivorship benefit for spouses, or you could take the pension payment as one big lump sum. It's important to evaluate all those options, the pros and cons of taking them, and seeing if there are other alternatives that can provide a guaranteed monthly income. CDs, investment grade bonds, government bonds, and fixed annuity interest, very secure in retirement. We like to rely on these for a very secure part of our clients' retirement income. Principal is secure, pays guaranteed interest over a set period of time. Now, the guarantees, there are different sources of the guarantee. They can be through the FDIC in the case of savings and CDs, underlying businesses in the case of investment grade corporate bonds, and the US government, both federal and state level, can guarantee government issued bonds. And finally, insurance companies guarantee and back the interest payments and the principal guarantees on fixed annuities. Interest rates have come up quite a bit over the last year and a half. Just about a year and a half ago, for example, a 5-year fixed CD was yielding about 1%. Today, it's yielding about 5. So this is one benefit we're seeing in an inflationary economy as the Federal Reserve raises interest rates, trying to get inflation under control. Savers can lock in some higher rates of return here. Pension annuities, they're becoming more and more in the mainstream. What I like to term pension annuities, they're income annuities that guarantee a monthly income, monthly or an annual income. They're issued by insurance companies, and it's contractually obligated to pay a set income for life in most cases. And there are 4 types that I really focus in on in our practice. Number 1 is the SPIA, single premium immediate annuity. That's where a client can purchase through one lump sum, guaranteed monthly income for life, and maybe a survivorship benefit as well. The DIA is a deferred income annuity. That's where a client can make a one lump sum purchase and purchase income in the future, where they might be setting up a pension stream of income when they're still working, maybe at age 50, and they start putting money away in these DIAs, and that will guarantee when they retire a set amount of money to be paid to them and their spouses for life. There's fixed indexed annuities with lifetime income guarantees. These contracts are linked to a stock market type index. And when the market does well, the interest or the insurance company will credit a certain percentage of the gain for the year to that contract. When the market does poorly, as it is doing this year, there is no loss of principal. And then there's also the qualified longevity annuity, where a client can purchase with part of their qualified 401k IRAs an annuity that will pay out in the future when they're older. In the event that they're running low on their retirement funds, this will ensure that they don't run out of income until throughout their retirement. Now, finally, there are investments, and these are non-guaranteed type investments. This is what most people are pretty used to through their 401ks. There's higher potential rates of return. They're not guaranteed. It includes mutual funds that invest in stocks, non-investment grade bonds, real estate. There's also non-mutual fund ETF type investments through private real estate investments, private equity, private credit. Each of these have their own sets of risks that must be managed, and they can offer higher potential rates of return, but there aren't any guarantees, and there's no guarantee on the principals. To segue into investment risk. There are four types to manage in retirement. Number one, there's market risk in retirement. It's, it's sometimes called systemic risk in financial circles. When the market's down or stays down, that's the risk of you losing money because of the market movements. There's also what I like to call permanent loss of capital. When a business goes out of business, their bonds and stock are worth zero. And that happens. Um, there's timing risk in retirement. When you retire, where is the market when you retire, and what does it do during the first couple of years of retirement when you're taking withdrawals from those retirement funds? We call that sequence of return risk. There's also longevity risk, or the risk that you could outlive your retirement savings if it's not managed properly. I like this slide because it really shows what can happen um, when investors retire at the wrong time and don't have a plan set up to take into account the possibility that they could be retiring during a down market. Investor number one and investor number two both have started out with $1 million at retirement. Investor number one, during the first couple of years of retirement, they experienced a 15% decline in the value of their accounts. All the while, they were withdrawing 5% of the account, $50,000 a year to live on. This results in their retirement funds being drawn down very quickly over less than 18 years. Quite a bit of a problem if a lot of people are living 30, 35 years in retirement. Investor number two experienced a 15% decline later in retirement during the 10th and 11th years of retirement. So their drawdown wasn't as drastic, but it still was a pretty substantial drawdown from where they were. And they weren't going to run out of money as quickly, but they're down much further than they would have been if they would have planned for this type of a decline in their retirement plan. Healthcare expenses. Um, Healthcare expenses can be quite substantial in retirement as well as before retirement. Insurance is usually in place to take care of unexpected healthcare expenses. When we retire at age 65, we have Medicare. Medicare is broken down in different parts. There's Part A, B, D, and then there's also supplemental insurance plan. Um, it starts at age 65 and it covers everything medically needed from emergency care to health, uh, hip replacements, knee replacements, um, back surgery, chronic care. It's covered under Medicare. Now, the costs are Part A is covered when you retire. That's you were contributing to that along with your employer during your working life. Part B, which covers non-hospital related expenses, but up to a certain point, costs $171 a month. That premium usually comes out of Social Security benefits, but if clients aren't taking Social Security at age 65, they will be billed for that. Supplemental insurance covers everything that Part A and Part B do not, which includes deductibles, co-pays, which can be quite substantial depending upon what is needed. And that supplemental insurance averages about $142 a month. Part D is the drug benefit plan, covers all required pharmaceuticals. Depending upon prescriptions and what clients need, that premium can range from $20 a month to $70 a month. The average is about $35 a month. Total amount for medical healthcare expenses, you have to figure that into your lifestyle planning, is $348 per individual in the household per month. So on healthcare expenses, what is not covered by Medicare? Um, Vision care, dental care, that is not covered by Medicare. The choice for clients is to pay from savings out of pocket or purchase a vision and dental policy. In my experience, the vision and dental policies are very limited in what they pay, but they can make sense for some clients. It's just important to evaluate different ways to either save money for these potential expenses during retirement or look at the vision and dental policies and see if it makes more sense to go that route. Long-term health care is not covered by Medicare expenses, nursing or home care, home-based health care. And by long-term, we mean Medicare will cover rehabilitative care if you were in a hospital and you had to um, uh, go through rehab in a nursing facility or other rehab type care, but it only covers it for 90 days. So if people need longer term care, in other words, if they're having trouble dressing, bathing, um, transferring, getting out of bed, eating, uh, if you need that type of care, if you need anywhere from 3 to 8 hours to sometimes 24-hour care a day, um, you have to figure out how you're going to cover that after 90 days. There's a 50% chance of needing this. This is sometime during your lifespan. 50% of people don't need it. 50% need it. Um, but it's just important to be aware of what those costs can be and the impact it can have on a retirement plan. So let's bring this all together. I'm going to present a client case to you. This is typical with maybe 35% of our clients. Of course, this is not an actual client, but it is a typical situation for about 35% of our clients. Bill and Colleen are age 62 and age 60 currently. They began working with our practice when Bill was age 55, Colleen was 53. The kids are grown out on their own. Bill works. He's a very successful sales professional. He has entirely W-2 income. Colleen did work initially. Then she stayed home with the kids until the last one started school. And she's been working part time ever since, about 15 years now, um, on the part time level. And she works as a consultant and she has W-2 income coming in. The retirement goal is when we started working together, it was really to start by taking longer vacations and trying out what it's like not to work as hard every week. And they want to travel now, and then they want to travel even more when they retire. They want to retire fully at age 65, Colleen at age 63. Although Bill has said, if I'm feeling pretty good and I'm not working as hard as I am right now, I may continue on. But we want to make sure that they're able to retire at age 65, just in case you're forced to retire at 65. So we started out with Bill and Colleen determining what their lifestyle spending is. Their current lifestyle spending comes out to almost $10,000 a month. But what I'd like to do is change the numbers a bit based upon what they'll be experiencing when they do retire to shoot for those numbers. So you start out with what you're spending now, what you're thinking of spending in the near future, um, and then you tweak the numbers a bit based upon how that spending is going to change a bit, primarily on the medical side, um, and work those numbers in. We also like to work a savings component into the retirement spending and try to shoot for anywhere from 5 to 8% of income, expected retirement income being saved on a monthly basis. I like to break it down between essential expenses, expenses that have to be covered every single month, no matter what. It doesn't matter if the market declines 50%. Um, that income has to be there to cover these expenses. Discretionary expenses can be adjusted based upon inflation as well as based upon um, expected monthly income from investments. After we develop and get an idea of what type of expenses need to be covered now and in retirement, because we do like our clients to live the way they want to live now as well as in retirement. Um, we develop sources of income. In Bill and Colleen's case, it made more sense to delay taking Social Security as long as they can. One of the reasons we like to develop multiple streams of income here is so you have a number of different levers to pull in case things change in your life. So, Bill and Colleen did not have access to a pension, but they had put away a pretty good amount in their 401ks. Between the two of them, when I started working with them, they were at about 1.1 million in 401k retirement money, and and that's pretty much all they had for savings. So we started developing a strategy where we could delay taking Social Security, develop some alternative pension types of income with their retirement assets, and with when we're developing a pension annuity strategy, we like to take into account and give some flexibility. Some of these payouts can change when interest rates go up. So we like to have some flexibility within the strategy to lock in higher rates of return down the line in case rates are higher when they retire. So one part of this pension annuity strategy that I developed for Bill and Colleen, again, a hypothetical client, was a bond ladder, a fixed annuity ladder that matures at age 65. If rates are higher and we're able to lock in a higher rate of return, either through bonds or fixed annuities or an immediate annuity, you're able to have that flexibility and take advantage of those higher rates with at least part of the strategy. So at age 65, though, we wanted to develop uh, delay taking the Social Security to maximize that. Um, we were able to draw about $9,000 a month from their IRAs and 401ks at that time after it's grown a bit. Remember, we started working with them when they were 55 and they're 62 right now, and Colleen's 60. So we're projecting the gross monthly income about $12,000. The effective tax rate, based upon some pre-planning we did back when they were 55, is only about 13%. Retirement income sources are taxed a little bit different at the state level. It depends on the state where you reside. For example, in Illinois, pensions, fixed annuities, income, income annuity income, Social Security, all that's not taxed at the state level. So you're able to save some money on taxes there. So their effective tax rate is mainly at the federal level, but we're able to get some tax-free income as well based upon some of the planning that we did. So the net monthly income came to about 10,483. And we need to cover about $9,885 a month to start to meet their spending. So this works. The third step when we're putting together the plan is to test the plan. We like to test it during multiple scenarios, including extended bear markets. Based upon this testing that we did, we optimized it, and there's an 86% probability of success. Now, there are multiple levers to pull in the plan. We could take Social Security income earlier. We could take some of the deferred income annuity income a little bit earlier, depending upon if the situation changes regarding investment risk and uh, the value of their accounts as they're drawing down the retirement assets. So what did they do? The strategy, to summarize, there's a lot more detail behind it. When they came to our practice, they had saved about $1.1 million for retirement. Um, we made sure that Bill was maxing out his 401k contributions. We shifted to a 50% Roth 401k, 50% of the contributions going into Bill's Roth. That allowed Bill to build up a tax-free source of IRA withdrawals when he retired. We also started out Roth conversion IRAs for both because Bill and Colleen were high income earners. They didn't qualify to contribute to a Roth directly, but they could put it into a non-deductible IRA, max it out at $7,000 each since they were over 50, and convert that over to a Roth IRA immediately. So all the income appreciation and withdrawals will be tax-free at retirement. We determined a pension annuity strategies to create another guaranteed source of income at retirement. Um, I will tell you, our clients that have pensions who are in retirement, and they are they sleep the soundest at night, and they tend to do the best with their investments as well because they're not as dependent upon those investment sources of income. So they can let those grow a little bit more in retirement. They began managing their investment accounts, including Bill's 401k, using Stanton Group's risk management approach. Um, we also helped them create a pool of capital of $550,000 each, guaranteed, tax-free, to protect other assets in the event either needs to fund long-term health care. This is separated out from their other assets, which protects those assets for the survivor as well as for the heirs. So we reached the end of our presentation. I'd like to open it up for any questions. Please use the chat box to run any questions by us. And our first question here: what rate of return was used to get the numbers in Bill and Colleen's plan? The average rate of return we model in is about a 5.5% rate of return. We're very conservative with that, and that's looking forward, not in the past. We hope to do better, but the more conservative you use the numbers, your surprises tend to be more on the upside. Yeah, I have another question here. How does investing before retirement and during the retirement differ? Before retirement, you can take on a little bit more risk, but once you're about 10 years or less to go until retirement, you got to be a little bit more conservative. You want to protect what you have. It's harder to get that money back once it's down. So we like to balance it out. We like to develop the sources of income in retirement on a conservative basis first, and then with investment type or at risk money, we like to manage those risks and take advantage of some opportunities. You take advantage of some risk opportunities on the private side for qualified clients that will give you a potential rate of return that's higher. Also, I'd like to add through the savings component during retirement, you're able to invest that money as well. Not just as those savings accounts build up, there are investment opportunities to, as long as you have enough for emergencies or have those lump sum amounts that are needed for taxes, travel out of the savings account. You can invest in, as long as you're aware of the risks, in a small portion that will give you the potential for higher rates of return in retirement. Here's another question: does it matter where I live in retirement? Um, well, that's important to determine based on lifestyle. Determine where you want to live. Most clients don't know before they retire. They've traveled, but they haven't spent a good amount of time in any one given place. They have some dreams about where they like to go. We do recommend to set up long-term vacations in the areas that they're thinking of settling down. Um, Spend a month uh, in an area that you have liked, maybe on a vacation. Um, a lot of our clients spend the first 4 or 5 years in retirement going on these long-term trips, and then they make a determination of where they want to be. There's a lot of different factors that come into play from the weather, the economic environment, the tax environment, the grandchild locations. That all comes into play when clients are figuring out where they want to settle down for retirement. But the numbers can make a difference. There are states that tax retirement income, and there are states that don't tax retirement income. So the numbers can definitely make a difference. Here's another question. If I have a monthly budget during retirement, how easy is it to adjust it if I need more? A lot of our clients, they make adjustments when we get closer to retirement. In retirement, we were talking to all our clients who have been in retirement, and there are clients that have been retired with our practice since 2005. So this year we had the cost of living has increased. It it depends on what the clients are spending money on, but we encouraged all our clients at the beginning of the year to go through the retirement spending worksheet with us again, based on their current expenses, and we can make adjustments. What we found was that with our income planning, they were going to get a bump anyway. So it was very easy to make up for that money that they needed based upon inflation. So it is, depending upon the planning you do ahead of time, based on the income sources and the levers you have to pull, you can make changes in what you need in retirement as during retirement. I think that is it. Thank you very much for joining us. We'd like to put out to everyone, you can schedule a discovery call or a meeting. At the meeting, you will meet with me, how we can help. We'll go through it through your personal situation. We can show you how we can help you on a personal basis. We'll introduce the Stanton Group Wealth Partners Financial Planning and Investment Research Team. our unique core and protect investment management process. There's no cost or obligation to sit down. It usually takes anywhere from a half an hour to 45 minutes. And we can do this in person or online, whichever is more convenient for you. To set this meeting up, you can email Erica, our office coordinator, and her email is ebukta@seacrestwm.com, or you can go directly to this link. I believe you can click on it. It's my calendar link and book a meeting with me directly. And our website, www.stantongwp.com, has links to set up the meeting as well. Thank you again, everyone. I hope everyone has a great evening.